Hello, everyone. Grayson Geiler here with SES Services. Weekly, I like to put out a market update, find some of the headlines from the financial news, go a little bit further into depth. Today, what I'd like to talk about is questioning whether or not the Federal Reserve has gone too far raising interest rates. Okay, so the Federal Reserve is on a breakneck pace of raising their interest rates, the overnight rate essentially. So don't think this is a long-term rate like you might get with a mortgage. But the short-term interest rate, essentially what commercial banks borrow from the Fed overnight from, 4.5%. Uh, that's high. That's higher than we've been since before the recession in 2008. So, consider after 2008, the Fed essentially took that interest rate to zero for the better part of a decade. After the spring of 2020, when the COVID hit, that interest rate was essentially zero. And now we are rocketing higher, 4.5%. So the question, an obvious question is, well, has the Fed gone too far? Because we have to add in there, remember, the Federal Reserve, as of February of 2022, was still buying bonds in the marketplace to support bond prices, inject liquidity, as they call it, into the economy. They were buying $80 billion worth of treasuries every month in February, $40 billion worth of mortgage-backed securities. That has stopped. Not only is that stopped, but the Fed, they're letting things run off their balance sheet, meaning anything they own that's maturing, they don't repurchase. So they're letting their balance sheet decline and rocketing interest rates so much higher. So of course, the question has to come up. Look, are we going to create a recession? Are we going to raise the rate too fast to the point that it breaks something in the economy? Well, some things around the world are already breaking. We've been talking about that for months now. It's insane that the Federal Reserve is standing on the brakes to stop the inflation that their policies incurred. It makes me wonder if maybe the Fed mistook the concept of a dual mandate, making them arsonist and firemen of the inflation out there. But anyway, this isn't an exact science, but when we're looking at some of the economic numbers, remember a lot of these economic numbers are lagging indicators. So we talked the last couple of weeks about some of the things that are really slowing down out there. The Chicago Purchasing Managers Index, for an example, an inverted yield curve. That's a very, very bearish indicator for financial markets, a negative indicator for the economy, meaning short-term interest rates are significantly higher than long-term interest rates, which is the obvious inverse of what should normally be going on out there. So that's another economic indicator. That the employment numbers are historically very lagging because, for all these economic indicators to come to the forefront, someone has to aggregate them and then dispense them. This isn't real-time data on how the economy is responding to what the Federal Reserve is doing. Some of these numbers are lagging. Some of them are really lagging because employment, there's another iteration. Not only does the economics do the economics of the situation have to make business owners think, hey, maybe we need to slow down on hiring, or maybe we actually need to let some people go. There's some lag time in there. So historically, employment is one of the latest of the indicators, as the progression comes about. Well, now all of a sudden, the Philadelphia Federal Reserve is admitting that their second quarter employment numbers overstated employment by as much as 1 million jobs, which is, that's a big deal. That's enough to move the needle. And now, just in the last few weeks, we've had a lot of big name companies, lots of companies indicating not hiring, indicating laying people off. Even some big name companies like Cisco, Goldman Sachs indicated last week that they're going to let up to 4,000 people go. And these are higher paying jobs, right? So these aren't jobs that come on very quickly. The hiring of isn't a knee-jerk reaction. The firing of isn't either. These are lagging indicator kind of jobs, even from the employment space perspective. So a lot of lagging indicators. One of the more real-time things I want to focus on a little bit today is the price of crude oil. Just take a look at the chart. I mean, we're sitting here in the mid 70s. Well, this is the price of crude oil back when before Russia invaded Ukraine. So that's an interesting indicator. The governments around the world, especially Europe, aren't easing off their discouraging of creating new crude oil. Russia is still demanding rubles for their crude oil. All these bullish crude oil price things are still going on, and yet the prices lag back into where it was in front of the war starting. So, that's intuitively you may think, hey, lower energy prices is great. That's bullish for the economy. When you look back at the correlation between crude oil prices and the economy, typically higher crude oil prices means an economy is doing better. But a few things to point out here when we're talking about lower crude oil prices indicating maybe the economy has already started sputtering. A few things to consider. Number one, a lower price is going to filter through the entire inflation situation. Now, keep in mind the Federal Reserve, the Labor Statistics Department, they always remove crude oil from the core CPI inflation numbers, but that's not the entirety of it. Obviously, energy prices are a huge economic input for everything that we do. So lower crude oil prices should be bringing inflation by any measure down. So that's one thing to consider. Also, we've got some lag time between now and when the Federal Reserve is meeting again. So maybe things like crude oil prices coming in will give the Fed a chance to pause. Before last week, they indicated that likely they're going to be raising rates again in February. Well, maybe this, among other things, is going to help them reconsider that. So we have a lot of conflicting indicators. In weeks past, we've talked precisely of that. It's a little bit crazy. We see very inflationary forces out there. We see very deflationary forces out there. Bullish economic or bullish financial asset indicators out there, bearish financial asset indicators out there. So it's a little bit crazy. Now, a lot of negativity is still baked into the market. A lot of people are still sitting on piles of cash waiting for better positions to buy in asset markets. Maybe people thinking about buying a house or holding off. Lots of different things going on out there right now. But with some of the negativity and people holding on to cash tends to make you think surprises might be to the upside rather than things going bad. Wall Street's disappointed that the Santa Claus rally didn't materialize. So some people are just taking their chips off the table and going home and calling it good for the holidays. So looking forward to seeing you in January. Hope everybody has a great Christmas, great holidays, great New Year, and we'll go from there. Hey, if you enjoy the weekly updates, forward it on to people. Feel free to reach out to us if you need some help for your specific situation. We offer our time free of obligation, free of cost. Click like on the button below. Subscribe to our channel. And again, have great holidays and hope to see you in the new year.